from Buyers Agency Australia. Before we dive into this month's update, a quick reminder. This is not financial advice. Everything I'm about to share is general in nature and should be considered as a guide only. Always seek personalised advice before making financial decisions. Now, let's dive into your full July 2025 Australian property market wrap. We'll be covering which markets are heating up, which markets are cooling off, what interest rates and lenders are doing right now, what we're buying, and what we're avoiding, current buyer sentiment, auction clearance rates and what they really mean, loan trends for owner-occupiers and investors, rental markets and vacancy, and some key infrastructure announcements across Queensland, New South Wales and Victoria. This is a jam-packed monthly wrap to help you stay sharp, make better decisions, and stay one step ahead. All right, let's start with the market. Where are we on the clock? We are seeing strong positive momentum across much of the country, with many metro markets either rising or in early growth phases. That includes key parts of Sydney, Melbourne, Brisbane, Perth and Adelaide. The notable thing here is that the capital city markets are mostly aligned right now in upward movement, and that's quite rare. Usually, Australian capital city markets rise and fall at different times due to localised factors such as population shifts, employment hubs, infrastructure development, and housing supply. When Sydney's booming, Brisbane might be cooling. When Melbourne's flat, Adelaide could be on the rise. So to see multiple capitals, including Sydney, Melbourne, Brisbane, Perth, and Adelaide, all entering a growth phase at the same time is rare. It signals that broader economic confidence and housing demand is strong enough to lift multiple markets at once, creating a more nationally synchronized upswing. For investors, this means there are more options in more places, but it also means greater competition across the board. Remember, markets move in cycles, and not all suburbs within a city rise at the same time, even if, as a whole, the city is rising. We're seeing some coastal and lifestyle regions plateau after strong COVID-era growth, while inner and middle ring suburbs of major cities are regaining steam. Let's zoom in on a few examples. Starting with Sydney's Blacktown and Penrith corridors. These are gaining traction again thanks to proximity to infrastructure projects like the new metro and hospital expansions. Investor interest is strong, but stock remains tight. In Melbourne, Casey and Hume, while some of the fringe estates have softened, areas like Craigieburn are seeing strong demand due to family appeal and affordability. Brisbane's Moreton Bay and further south, the Logan area, suburbs like Crestmead and Marsden, are rising quickly due to tight rental demands and improved transport access. Across all three capitals, it's about understanding the micro markets and not taking median price growth at face value. So, what's the RBA doing? The Reserve Bank of Australia chose to keep the cash rate at 3.85% in July, despite widespread expectations for a cut. This cautious decision was driven by a need for more confirmation that inflation would stay sustainably within the 2 to 3% target range. As Governor Michelle Bullock and most board members emphasised, the RBA is waiting for the June quarter CPI data and clearer labour market signals before easing policy. Holding rates signals that while inflation is trending downward, the economy remains fragile and the labour market still supports price pressure. So what does this mean for property and the economy? First, for homeowners and investors, this decision delays immediate mortgage relief. Borrowing capacity remains constrained because lenders continue testing borrowers at a rate 2 to 3% higher than the actual rate, limiting lending power more than the headline rate might suggest. On the economy side, the delay helps avoid reigniting inflation too quickly, a potential risk if rate cuts arrive too early. The RBA's message is clear. Easing is not off the table, but timing must be right, and right now, it's too soon. For property investors, this translates to a continued environment of moderate yields and cautious demand, but not market freeze. Those who can service current repayment levels without stress are gravitational anchors. They keep buyer interest stable. Meanwhile, expected rate cuts in the coming months could unlock a wave of spring buying activity, especially in well-performing suburbs where supply remains tight and rental yields remain attractive. This means that behind the scenes, things are shifting. Inflation has remained sticky in some sectors, like insurance and services, but wage growth is finally helping to balance things out. We're now seeing stronger expectations that further rate cuts could come soon, potentially later this year or early 2026. Even with the hold, some lenders are already adjusting their appetite, and you as an investor must be mindful. Fixed rates are being trimmed slightly. This signals that banks expect rates to fall and are trying to lock in borrowers before that happens. Looking at fixed rates lets you see what the banks are gambling on the RBA doing. Loan buffers remain tight. Most lenders are still assessing at 2.5 to 3% above the actual rate, which means borrowing power is still restricted, especially for first-time buyers and upgraders. Second-tier lenders are competing hard. This means investors with complex structures or self-employed income are getting better outcomes when they step outside the big four banks. For investors, this translates to slightly improving access, but it's still a market for those who can present clean, well-prepared finance applications. As always, seek advice from your mortgage broker. So, what are we buying at the moment for our clients? We are laser focused on fundamentals first assets. Right now, we're buying established homes on land in metro fringe locations. Freestanding houses with land content remain the backbone of long-term performance, particularly when it comes to long-term value-adding potential. Dual income properties or homes with granny flat potential. These offer cash flow resilience and high tenant appeal in a tight rental market. Properties with renovation upside. Value adding now helps fast track equity growth and reset depreciation benefits, especially in a flat market while we wait for that incoming growth. The common thread: low vacancy, high tenant demand, and medium to long-term growth potential. These are not speculative plays. They're grounded in strong fundamentals. What are we avoiding? We are steering clear of high-density apartments in oversupplied pockets. Greenfield house and land packages with delayed infrastructure. Overcooked coastal markets with softening yields. Townhouses. We are not acquiring these at all currently. It's about preserving future resale value and staying clear of markets that depend on short-term sentiment. In a flat or stagnating market, all of these asset types are simply far too risky. Click the link below and book a free meeting with a member of our strategy team to find out exactly why these types of properties are in our no-go zones. Now, let's take a look at market sentiment. How are buyers feeling? How much confidence do we have in the market at the moment? There's a visible emotional divide in the market. Owner-occupiers are cautious, even anxious. Many of them are stuck in limbo. They want to upgrade or relocate, but uncertainty around interest rates is making them hesitant. They're nervous that rate cuts may not come soon enough, or that borrowing power won't improve in time to make a move viable. This emotional caution is slowing demand slightly, especially in more expensive price brackets where every percentage price point of interest makes a difference. First home buyers, meanwhile, are facing exhaustion. The deposit hurdle is higher than ever thanks to inflated property prices and limited wage growth, and servicing loans under strict lending criteria is increasingly difficult. Even with incentives, many are burning out from trying to get into the market, or they're compromising heavily on quality or location. Investors are split right down the middle. On one side, you have the seasoned players. They've seen this all before and know this lull is temporary. They're taking advantage of less competition, strong rents, and motivated sellers. On the other side, you have newer or more emotionally driven investors who are paralyzed by fear of buying at the top, even though we're not there yet. That hesitation is leaving value on the table, especially in growth markets with tight vacancy and infrastructure tailwinds. This emotional fragmentation across buyer groups is shaping price growth, supply pressures, and transaction volumes differently in each market segment. Risk appetite is lower overall, but savvy players are seeing this as a discounted window to secure good assets without FOMO-driven competition, which we will see more of once prices start moving upwards more steadily. Let's now take a look at auction clearance rates on the East Coast and what they're telling us. Current clearance rates in Sydney and Melbourne are about 65 to 70%. Brisbane, around 50%. These rates matter even if you're not buying at auction. Why? Because they reflect how hot or cold buyer sentiment really is in real time. A 65 to 70% clearance rate, like we're seeing in Sydney and Melbourne, indicates strong demand, tight supply, and sellers achieving their price expectations. It tells us buyers are showing up, bidding hard, and accepting the current pricing, which drives further price momentum and fuels confidence across the board. Brisbane's lower rate, sitting closer to 50%, is partly because auctions aren't the dominant method of sale there, but it also points to more price-sensitive buyers, especially investors who are looking for value and not getting caught up in bidding wars. In all cities, clearance rates are a live measure of urgency, vendor realism, and buyer depth, and they ripple through to every part of the market, even private treaty sales. Now, let's look at loan trends. We're seeing owner-occupiers behave with caution, structuring their loans to preserve as much flexibility as possible in an uncertain interest rate environment. Many are opting for variable or split loans to avoid being locked into high fixed rates, especially with cuts now looking more likely within the next 6 to 12 months. Offset accounts are being used aggressively as a strategy to reduce interest while keeping funds accessible. Short-term fixed loans of 1 to 2 years are still being chosen by some buyers as a hedge against short-term rate volatility, but most are avoiding long-term fixes. The broader theme here is one of optionality. Buyers want room to pivot as conditions change, rather than being locked into commitments that may not serve them in a falling rate cycle. So what about investor loans? Smart investors right now are playing a longer, more strategic game. They're using interest-only loans, not just to minimize repayments, but to free up monthly cash flow so that money can be redirected into renovations, new acquisitions, or buffering rising holding costs. At the same time, They're tapping into equity, that is, unlocking capital gains from properties they already own to fund new purchases without needing to drain their savings. This leapfrogs them into new assets while keeping liquidity intact. Finally, they're spreading lending exposure across multiple banks to prevent one lender's policy from blocking future growth. This not only preserves their borrowing capacity, but also avoids raising red flags in the credit system. It's a smart shift from buy one, wait, repeat into dynamic portfolio-focused structuring, setting them up to grow faster and safer in the years ahead. Now let's look at rental markets, vacancy, and trends. Vacancy is extremely tight, especially in middle ring family-friendly suburbs across all three East Coast states. Let's zoom in on 3 suburb trends in these areas. Campbelltown, New South Wales. Vacancy is consistently under 1%, with most properties leasing within 5 to 7 days of hitting the market. The area benefits from proximity to major employment precincts like Liverpool Hospital, Western Sydney Airport development zones, and several major logistics hubs. This strong employment base means tenant demand remains high and consistent, particularly for family homes. Rental yields have lifted significantly in the past 12 months, offering solid cash flow for investors. Morayfield, Queensland. Open homes in this area are attracting double-digit application numbers, often with homes leased after just one open home. This demand is driven largely by young families and working couples priced out of Brisbane's inner and middle rings. The presence of multiple schools, shopping centres and rail links adds to the appeal, while vacancy rates remain well below 1%. This is a clear example of the spillover effect as tenants move further out in search of affordability without compromising too much on lifestyle. Craigieburn, Victoria. This corridor has seen explosive growth in tenant demand, particularly from migrant communities looking for larger family-friendly homes. There is a critical undersupply of 4-bedroom homes, creating rental bidding scenarios and upward pressure on rents. Infrastructure, including access to the Hume Freeway and new rail upgrades, has improved accessibility to the city, while community facilities continue to expand. The strong cultural networks in the area also contribute to tenant stickiness, making it a stable rental investment location. These pockets represent a wider trend. Working class affordability plus good transport equals reliable tenant demand. Infrastructure announcements. Looking ahead in Queensland, a $2.5 billion transport infrastructure package has been announced to supercharge connectivity ahead of the 2032 Olympics, and the flow-on effects for property markets are already underway. The Logan to Brisbane rail duplication will dramatically improve travel times and frequency along one of the most critical commuter corridors in the state, lifting appeal in suburbs like Woodridge, Kingston and Beenleigh. The Coomera Connector, Stages 1 and 2, dubbed the second M1, will relieve pressure on the current motorway and improve access for northern Gold Coast suburbs like Pimpama, making it more viable for families and investors. Meanwhile, Ipswich road upgrades are finally addressing years of congestion, unlocking residential growth potential in affordable corridors like Redbank Plains and Bellbird Park. Collectively, these projects are cutting commute times, attracting new employment nodes, and unlocking land for new development, which means uplift in both demand and value across the entire southeast Queensland corridor. New South Wales. The Western Sydney Metro expansion is progressing rapidly, with tunnelling now well underway, and once complete, this line will connect Parramatta to the Sydney CBD in under 25 minutes, a game changer for the West. It shifts the centre of gravity westward, rebalancing Sydney's urban structure. This is a major win for suburbs like Rydalmere, Silverwater, and Wentworth Point, which have historically lagged in connectivity and infrastructure. Improved accessibility means rising livability, stronger buyer demand, and higher investor confidence. As more employment centres decentralise to Parramatta, these surrounding suburbs will benefit from both capital growth and rental yield uplift. This is a textbook case of how transformative infrastructure can activate previously underperforming pockets. Victoria. The North East Link is one of the largest road infrastructure projects in Victoria's history, and tunnelling is officially underway. Once complete, this project will remove over 15,000 trucks from local roads each day, easing congestion significantly across the eastern suburbs. The travel time from Ringwood to Melbourne Airport will be slashed by up to 30 minutes, dramatically improving accessibility for both residents and businesses. Suburbs like Watsonia and Bulleen, previously constrained by poor traffic flow, are now seeing renewed interest from both owner-occupiers and investors. Reduced noise pollution, faster access to the city and airport, and improved freight routes means greater commercial appeal, rising livability, and increased property values. This kind of infrastructure acts as a long-term growth engine, and those positioned in the corridor early are set to benefit most. So, final thoughts. Where are we headed? July confirmed the direction. The market is rising, slowly, deliberately. Rental demand is high, vacancies are tight, interest rates will ease, but not in a rush. Smart investors are buying now, not waiting. As always, it's about buying well, not buying everything. Want help cutting through the noise and building a portfolio with resilience and upside? Book a free 15-minute discovery call. No hard sell, just straight answers. www.propertysession.com.au/15 or check out the links below. I'm Amanda from Buyers Agency Australia. Thanks for tuning in.